We're rolling? We're rolling. When I first started in this business, we actually did the work. We poured over fundamentals, we studied charts, we read the filings line by line. Today, you don't seem to need any of that. Just follow a social media feed and let bots tell you what the market's thinking. I'm half kidding, yeah. But every portfolio manager out there knows exactly what I'm talking about. That's the world we live in today. If value is the only thing that mattered, Apple would be trading at 100. Headlines, the algos, tape-reading robots, and who can hit the send button first. In the short run, this is what we're up against. Let me take you through the week. Textbook. The market was all over the map. Tariffs front and center. 1 minute, the U.S. Trade Court slams on the brakes, rules Trump's tariffs illegal. A few hours later, an appeals court says, hold on, keeps the tariffs in place while the administration appeals maybe all the way to the Supreme Court. Look, if you think this administration is out of options, you're not paying attention. They have tools. They could hit the reset button with temporary tariffs up to 15% under Section 122 of the 1974 Trade Act. Or they can bring in the heavy artillery, Section 301 tariffs. And maybe that's what they should have done. Go back to the playbook that worked in the first term. The game is about leverage and how to hold on to it. Because if they lose the ability to raise tariff and revenue, the one big beautiful bill sitting in the Senate, it's toast. Fiscal hawks are all over this legislation. And unfortunately, it is now in the hands of politicians. And they got different priorities. Rule 1, bring home the bacon and get reelected. Rule 2, help the country. Then comes to today, Friday, midday. The bots light up the tape with a headline, China violated their agreement, U.S. planning wider tech sanctions. Well, the market tanked, down over 1% in just a couple of minutes. It took a few hours, but by the close, we clawed back almost to the flat line. Why? Because Trump says he's ready to pick up the phone and maybe talk to Xi. Tough when you need to be, but always ready to make a deal. It was a big week, big month, and even bigger month ahead. And all in, this is the new game. And understanding the rules to that game are key to surviving this market. This isn't about wishful thinking. It's about hard choices, the risks, and conviction. Welcome to The Money Runner. I'm David Nelson. May was a powerful month, and it's great that, by and large, most markets are back in the green. That's the good news. And this chart that I've been showing every week shows we've seen some repair. You can see that line on top there, that golden line, that's earnings are back on I-95 North, and that's important because we need that, because in the long run, stocks follow earnings. The green line, therein lies the problem. That's the PE ratio. And right now, markets are again expensive. And valuations don't live in a vacuum. They live relative to treasury yields, the risk-free rate. And that's the problem. Because if you look at the bottom end and you see that 30-year treasury, we've reached that 5%. We've done it a couple of times. And every time we get up there, stocks struggle. We saw it back in 2023. We had a pretty big drawdown when yields got up there. It's happened again this month. And stocks just do not like that. And I bring it up because on Friday, to close out the week, Jamie Dimon was at an economic forum, and he had some important words to say that actually moved the tape. You know, it's not every day you hear a CEO of the biggest bank in America warn about cracks in the bond market. But that's exactly what Jamie Dimon did this week. He didn't mince words. You're going to see a crack in the bond market. It's going to happen. You're going to panic. And he's talking about you. I'm not going to panic. He's talking about J.P. Morgan, his firm. We'll be fine. We'll probably make more money. That's classic Dimon. And to be fair, Jamie isn't always right, but he's a heavyweight. And when he speaks, you can bet markets listen. The U.S. is running debt and deficits that are unsustainable. And frankly, the only reason we've been able to get away with it is that we are the consumer of the world. And at least so far, the dollar is the world's reserve currency. That is not a given. I've been writing articles about it and doing podcasts on this subject for years. And I think what Jamie understands is that eventually buyers of U.S. Treasuries are going to demand a higher return as long as the debt and interest on our debt keeps climbing. I don't want to end this month or this podcast on a down note. The investment theme that started this bull market 2 years ago, it's still in place. No surprise here. Artificial intelligence is still an important driver, and the infrastructure race, it's on. Microsoft's latest earnings showed Azure growing at 33% year over year, with AI workloads driving nearly half that growth. CapEx, they poured in $16.8 billion last quarter, much of it going towards AI data centers. And NVIDIA earnings, no question. Blackwell chips, the demand is white hot. And let's not forget last week's announcement that Oracle was stepping up to buy 400,000 chips from NVIDIA. $40 billion, serious money. The takeaway? AI isn't just a buzzword. It's driving massive capital investment, reshaping corporate priorities, and setting the stage for the next decade of growth. We know the growth is real at many of these companies. Our job as investors, analysts, and portfolio managers is to decide when and if we are paying too much for that growth. That's job one. Job two is finding the new companies that are coming up the ranks ready to disrupt the status quo. All right, that's it for this week. Don't forget, if you want to learn more about yours truly or the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is The Money Runner.